Bonds are also a very popular way you can start investing in a business. Some people might prefer to invest in bonds because of the lower risk that they carry relative to owning stocks, for example. Because the first is a fixed income asset, so you already know what your return will be beforehand. Some other investors might also use bonds as a way to diversify and lower the risk in their portfolio. Today, let's take a closer look at bonds and answer a question that most investors usually have. Are they better than stocks? Let's begin with a brief explanation of how stocks work that might help you understand why companies issue bonds. When a company goes public or has their IPO or initial public offering, they basically sell equity in the business. This is because by buying shares, you're part owner of that business as you're buying a percentage of it. Companies do this to raise capital and fund their future growth. Once you become a shareholder or a part owner, you'll be compensated when the company does well and their share price increases. Or, as a partial owner, you also assume the downside risk when the company doesn't perform as expected and the value of your shares goes down. Now, a company will still need to raise more capital at some point in the future to keep funding its growth and improve their performance. And they can do this either by issuing new shares, and while they can avoid paying interest doing it this way, it is not really beneficial for current investors because if they sell more equity, your ownership in the business will be diluted. So now you'll own a smaller portion of the business, and your earnings per share will also be reduced because there are now more shares in the market to distribute the earnings to. The other two ways a business can raise funds without affecting the ownership of their current shareholders is by incurring into debt. This includes either getting a loan from a bank or doing it from investors, which is where bonds take place. When you buy a bond, you're basically lending money to the bond issuer. This money that you lend them is known as the face value of the bond, or the par value. The bond issuer will pay you interest, also known as coupon payments, during the life of the bond. These payments are usually done on a semi-annual basis, and when it reaches maturity date, which is the date when the bond ends, you'll be given the final coupon and the entire face value you had paid initially. For example, if a bond is issued at a face value of $1,000 and its maturity date will be in 3 years, and they pay a coupon rate, which is the percentage of annual interest you'll receive as a bondholder of 3%. Then, you'll receive $30 a year until the bond expires. If the payments are semi-annual, you'll receive coupon payments twice a year for $15 each. On maturity, you'll receive $1,015 back, which is the last coupon payment and the principal of $1,000 you paid in the first place. Bonds are also called different names depending on their maturity date. The short-term ones that last a year or less are called bills. Medium-term ones from 1 year to 10 years are usually referred to as notes, and from 10 years and above are called bonds. Bonds can be issued by the government at a federal level, which are known as treasury bonds, and at a state level or local level, which are municipal bonds, also known as munis for short. The government sells these bonds to fund projects like fixing or creating infrastructure, other capital expenditures, and even to finance wars. Treasury bonds are usually long-term, and their maturity can be up to 30 years. You can also have treasury bills, which can have a maturity date of as low as 4 weeks. Usually, this second doesn't pay dividends on regular coupon payments, but they instead sell you the bond in the first place at a discount to their par value, and you receive the entire face value at maturity. These are also called zero coupon bonds. For example, if a treasury bill par value is $1,000, you can purchase it for $950 and at maturity you'll receive $1,000. As an interesting fact, most times munis are tax exempt, unlike treasuries which are taxable. But not only the government can raise capital to fund their projects, but also corporations, and they can also issue bonds. These are called corporate bonds and basically works the same way. You lend money to a certain corporation and they will pay back the face value of the bond plus a certain interest rate or coupon rate to compensate you for lending the money. Now, lending money will of course carry some risks. And just like stockholders carry the risk of the company not performing well, decreasing the price of their shares, bondholders carry some risks too. But the two most important ones are either the bond issuer getting to default, so failing to pay back the debt, or increases on interest rates. Let's take a closer look at these two risk factors. Let's start with the risk of default. In this case, government bonds are a safer option than corporate bonds. This is because governments like the United States or the UK, for example, have a history of paying back successfully. And well, after all, it is easier for a corporation to go bankrupt than it is for a government. However, there is an investing rule that applies to pretty much any asset you want to invest in, which is the lower the risk, the lower the reward, and the higher the risk, the higher the reward. And you'll see a lot of that during this video. While government bonds are safer, they also pay a lower yield than corporate bonds. Time to maturity also plays an important role when it comes to the yield that a bond will have. The longer it takes for a bond to reach maturity, the longer it will take for you to get your money back, and the more exposed you will be to changes in the financial environment, like interest rates increases, which we'll cover in a minute. Therefore, taking our last example, treasury bonds with maturity of 10 years to 30 years in a healthy economy will pay a higher yield than short-term treasury bills to compensate for the risk that bondholders carry. Now, as mentioned, corporations are more prompt to default than governments are, but certainly some corporations more than others. This is why each company has a credit rating that will be very useful to you when choosing companies to lend money and which ones not to. These ratings are assigned by a credit rating business like Standard & Poor's or Moody's. And here's the way they work. They rate companies with these scores that you see on screen, where anything from BBB to AAA is considered investment grade or high grade. These are basically the safest options you can go for. And basically the difference from AAA as you go down to BBB is that the lower you go means that they're still good, but the lower, the more exposed it could be to changes in the market. However, it all changes when you get to this section from BB to C. These are non-investment grade or junk bonds and represent riskier companies to lend money to. So their chances of getting to default, or in other words, your chances of not getting paid back, are higher. D is the lowest score you can get, and this is given when a company is already at default. Now, remember the last rule we mentioned about risk? As you might expect, anything from AAA to BBB will pay a smaller interest than lower rating companies, because since their reputation is not the best, they need to offer higher yields to be able to attract investors to lend them money. However, this is a double-edged sword, because while a higher interest payment can be attractive, a low rating and a high yield are not really a good combination. So that is when it comes to default risk and how you can have an idea of the risk that you have as a creditor of not getting repaid. But how about the second risk factor, which are interest rates? How can this affect bonds? And the thing is that bonds work the same way as stocks, in the sense that the only time that a company receives money by selling shares is in the primary market during their IPO, or when they issue new stock after they had their IPO, and they sell them to investors at a specific price. Once they sell those shares, these assets go into the secondary market, which is when they are traded among investors, and because of bid and ask prices and speculation, their prices start to fluctuate. So when you buy, let's say, a Tesla stock, it's not like Tesla is receiving your money, but you're most likely buying it from another investor that is selling it. Bonds work the same way. They're first issued by either the government or a company, and then, Once the bond issuer collects his money, these bonds can still be traded in the secondary market among investors, and this is where things start to change. Let's take the first example about the $1,000 bond that paid you 3% on annual interest and had 3 years until maturity. From the perspective of the bond issuer, the 3% interest or $30 a year will never change. This will remain the same way during the entire life of the bond. And so will the time to maturity. It will still be 3 years because that is how much the bond issuer agreed to pay you and the length of the agreement. Nothing more, nothing less. So, from the bond's issuer perspective, nothing will change until the bond reaches maturity and ceases to exist. However, from your perspective and the perspective of other investors that buy your bond in the secondary market, some of these things will in fact change. So, since you do not have to hold a bond until its maturity, and you can decide to sell it to another investor before it expires, this can change its face value, which is the $1,000 you paid for it initially, depending on interest rates. And if their face value increases or decreases, whatever interest the bond has, in our example, the $30 a year, well, those $30 will represent a higher or lower percentage for the new person who buys your bond, depending on how much they pay for it, either less or more than $1,000, which was the original face value. Interest rates and bond prices are indirectly proportional. Thus, if interest rates increase, let's say from 3% to 4%, the value of your bond will decrease. This is because you bought the bond at a coupon rate of 3%. So this increase on interest rates will not apply to existing bonds with lower fixed coupon rates, but to newly issued bonds. So if you want to sell your 3% bond at the same face value of $1,000 you paid, why would an investor want to buy it for that price when they can buy a new bond for the same price and get a 4% return or $40 a year instead of $30? So in order to sell it, you need to sell it at a discount to par. So you need to apply a discount to the $1,000 you paid. And because the person that will acquire it will still receive $30 a year, but he paid a smaller face value, those $30 will now represent a higher percentage. The opposite is also true. If interest rates decrease from 3% to, say, 2%, your bond will be more valuable because it pays a higher coupon rate than new bonds in the market. So the higher return can be more attractive to investors that are willing to pay a higher face value than what you paid to buy your bond. So you can sell it at a premium to par or at a price higher than $1,000. So now your question might be, what discount or premium should I apply to my bond if I wanted to sell it? And here's the thing. Increases and decreases on interest rates will affect bonds differently. When interest rates increase, some bonds might lose more value than others. And when they decrease, some will be more benefited than others. This is determined by something called duration. And this is not to be confused with time to maturity. The time to maturity, which has already been explained, is basically the length of the bond, from the time it is issued until it ceases to exist and your principal is paid back to you. Duration, on the other hand, measures the sensitivity of the bond relative to interest rate changes. In other words, it helps us know how much the face value of the bond will change when there are higher or lower rates in the market. Now, duration is a complex calculation that certainly deserves a separate video to be explained in detail, which I will surely be making soon. So in the meantime, and to make this video as simple as possible, I'll tell you what you can interpret from the result of duration and what things can influence this result. And by the way, you can also find online calculators to make this a lot easier. So if you have a duration of 5, for example, it means that your bond will increase or decrease in value by about 5% for each 1% interest rate decrease or increase respectively. The longer the maturity date, the higher the duration will be, because of the higher risk bondholders carry of changes in the economy and vice versa. Also, the lower the coupon rate is, the higher the duration will be as well. Because if they pay less interest, the longer it will take for you to get your money back, so it's more risky. Duration will also be directly proportional to interest rates. So when interest rates increase or decrease, duration will be affected just the same way. Once the video about this is available in this channel, you will be able to find it in the upper corner of this video or in the description below. You can trade bonds individually or by buying a bond mutual fund or ETF, which are very practical options. This way, you lower your risk considerably because instead of depending on a single business to pay you back, your capital is distributed among several different bonds issued by several different corporations that are also diversified in ratings. So if one of the companies that is part of the pool gets to default, the impact will not be as strong as owning that individual bond in that company. You can take, for example, Vanguard's BND ETF. This is an ETF that holds over 10,000 bonds in a combination of corporate and government bonds. They only invest in this section of the corporate bond rating, so it's a very low risk investment. Now, the million-dollar question: are bonds better than stocks? And the answer to this might vary from investor to investor, because it actually depends on your risk tolerance and your investing goals. Warren Buffett says that when you buy a stock or when you analyze a business, what you try to do is to basically turn a stock certificate into a bond certificate. This is because a bond specifies what your returns will be and when you're going to receive them, while a stock doesn't. So investors that put their money into a variable income instrument such as a stock rely on their prediction or future forecast of their returns, which might not be accurate. When a company goes bankrupt, its assets can be used as collateral. This means that debt holders like banks and bond holders can seize their assets to get their money back. When a company asks for a loan, they can also use collateral in the terms of the loan. These are called secured loans because the company pledges a specific asset that could be a property or equipment to be sold in case they are unable to pay the debt. And when a company uses collateral, it reduces the amount of interest they have to pay to banks or to bondholders because it makes the investment safer. Bondholders that do not hold bonds with collateral, also known as unsecured loans or debentures, still have the same right in case their assets are seized, but the priority varies. Debentures can be divided into two different categories: senior debentures and junior debentures. So secured loan holders, senior debentures, and junior debentures will be prioritized in that order respectively. However, shareholders are last on this list, and if the company goes bankrupt, they can lose everything if there's nothing left after paying their creditors. Now, owning bonds also has downsides, like the company getting to default or exposure to interest rates, as we mentioned. But most importantly, stocks usually have a much higher return than bonds. Warren Buffett once shared his opinion in one of Berkshire's investor meetings about long-term bonds at 3% rates by the time to be a terrible investment at those rates. And it actually makes sense. If you're going to get a return of 3%, but at the same time the Fed wants to keep inflation levels at a maximum of 2% a year, the inflation factor will bring your return closer to 1%, not taking into account the taxes you need to pay on that income. So you end up with just half a percentage of return, which if you had taken that money and maybe put it in the equities market, you would have gotten a much higher return. The upside of a stockholder is uncapped because you're part owner of that business. And in case they perform really well and the stock price increases a lot, you'll be benefited from this as long as it keeps growing. Whereas a bondholder doesn't have any equity in the business and their upside is capped because they will only receive their principal plus their interest payments, and that's it, in case they hold the bond to maturity, of course. Remember, you don't necessarily need to think of stocks and bonds in terms of one or the other. but you can also mix both in your portfolio for better risk management. I thank you for watching this video. I hope you learned something new. And don't forget to subscribe. You're going to find new videos every week in case you want to get more content like this. See ya.